Okay, let's just dive right into this explainer. Look, if you're building a business, you already know the deal. Managing the numbers, it can honestly feel like you're trying to solve a 1,000-piece puzzle. In the dark, it is incredibly tough. But here's the really empowering truth we pulled from our source material today, the Entrepreneur's Guide to Financial Course Correction. Getting off track? Completely normal. Staying off track? Well, that's a choice. Course correcting your business is entirely possible once you know exactly what to look for. So today, we're going to illuminate that path forward. We're breaking down the 5 specific financial mistakes entrepreneurs are making literally right now and exactly how to fix them.
But before we get to the solutions, we kind of need to take a hard look in the mirror. Are you sabotaging your own profits? Seriously, ask yourself that with genuine curiosity. Is your business's cash flow secretly suffering from self-inflicted wounds that you just haven't diagnosed yet? So often we want to blame the market, right? Or the algorithm, or the competition for our tight margins. But the reality highlighted in our guide is that the most dangerous threats to your profitability are usually internal habits. They're the blind spots in our own day-to-day financial management.
Section 1. The need for course correction. Diagnosing the symptoms. Let's get into it.
Section 2. Early-stage financial traps. Foundational errors.
Okay, mistake number 1, commingling personal and business funds. Now, we all know how this starts, right? It starts totally innocently. You pay for your 2 a.m. Netflix binge with the corporate card, or maybe you deposit a quick client check into your personal checking account just to save time. But let me tell you, this creates an absolute nightmare for bookkeeping, liability, and tax prep. It's a mess. The course correction here is total financial separation. You've got to draw a hard, non-negotiable line in the sand between your personal wallet and your company's treasury. No exceptions.
So here is exactly how you fix it. Step 1, open dedicated business checking and savings accounts today, like right now. Step 2, secure a dedicated business credit card and absolutely never use it for groceries or personal items. Just don't do it. And step 3, stop treating the business account like a personal ATM. Instead, establish a routine, documented owner's draw or a set salary. Injecting this discipline instantly clarifies your business's true operating cost. Moving on to Section 3, hidden cash flow leaks, daily inefficiencies.
All right, mistake number 2 is maintaining passive accounts receivable. If you're doing the work, sending the invoice, and then just sitting back hoping they pay on time, you are essentially acting like a bank offering free, interest-free loans to your clients. The correction here is proactive invoice management. You need to aggressively protect your cash. Remember, you're running a business, not a charity, and you have to protect the absolute lifeblood of your operation, which is cash in the bank.
I want you to apply these specific, structured steps to your own books to plug that financial leak immediately. First, stop financing your clients' projects out of your own pocket. Require upfront deposits before any work actually begins. Second, shorten your payment terms. If you're currently at net 30, meaning clients have 30 days to pay you, move that to net 15 or even due on receipt. Third, remove the human emotion from asking for money. Automate your follow-up reminders and enforce late fees right through your accounting software. Make getting paid an automated system, not a personal favor you have to beg for.
Now on to mistake number 3, and this is a big one. Confusing profit with cash flow. It's so easy to look at your profit and loss statement, see a positive number and think, yes, I'm rich. But remember this, profit is an accounting concept. Cash is reality. If your so-called profit is completely tied up in inventory or unpaid invoices, you can absolutely still go bankrupt while technically being profitable. Crazy, right? The course correction here is granular cash flow forecasting. You need a headlights-on approach to see the cash hitting the wall way before you crash.
To fix this and regain absolute control, you need to map out your specific weekly cash inflows and outflows. Don't just look back at what happened, build a rolling 13-week cash forecast to anticipate what is actually coming down the pipeline. Ask yourself, when do large annual bills hit? When does payroll land relative to when clients actually pay? And finally, establish an emergency cash buffer. You need a safety net of liquid cash to absorb the inevitable shockwaves of running a business, because trust me, they will come.
Section 4. Strategic errors in growth. Long-term expansion.
You know, surviving those early days is fantastic, but scaling amplifies literally everything. A tiny error in your growth strategy can multiply into a catastrophic financial loss. So, mistake number 4 is underpricing for market share. This leaves you trapped in this dark cave of tight margins, just racing to the bottom to win clients who honestly only care about price, not quality. The course correction? Value-based pricing. You need to step into the light and price your offerings based on the transformation and the real value you deliver. Here's how you actually build that value-based model. First, audit your actual delivery costs. Most entrepreneurs vastly underestimate their true overhead. It's wild. Second, define your unique value proposition. Why are you better, faster, or more reliable than the alternative out there? Really nail that down. Once you have that clarity, step 3 is to incrementally test higher price points with new clients. You'll probably find that you might lose a fraction of your bargain hunting clients, but you'll still make more money with way less stress. It's a huge win.
Finally, we arrive at the fifth and often most dangerous strategic mistake: premature scaling. This is hiring that massive team, leasing that huge fancy office space, or buying a crazy expensive artisanal espresso machine for the break room way before the core business model is actually profitable. It's basically letting your ego dictate your expenses, and it will absolutely cause your foundation to crumble. The correction here is absolutely critical: milestone-based scaling. You don't spend the money just because you want to grow. You spend the money because the hard metrics prove you need to grow.
Here's the final prescription in our checkup, giving you the clear steps required to secure your ultimate financial resilience. 1. Define clear, objective revenue triggers. For example, say, I will only hire this new role when we hit X dollars in recurring revenue. 2. Leverage contractors and fractional help, like part-time specialized experts, to test the waters before committing to the heavy overhead of full-time staff. 3. Continually audit the ROI of any new capacity you add. Look, if a new expense isn't freeing up your time to make more money or directly generating revenue itself, it's just a liability, plain and simple.
Section 5. Executing your financial fixes. Implementation. We all know information without implementation is basically just entertainment. So let's do a rapid-fire recap of all 5 course corrections to permanently solidify your new, highly effective financial playbook. 1. Establish total separation between personal and business funds. 2. Move to proactive invoice management to get cash in the door way faster. 3. Implement a 13-week cash flow forecast so you can actually see the road ahead. 4. Transition to value-based pricing to fiercely protect your margins. And 5. Adopt milestone-based scaling to ensure your growth is sustainable, not ego-driven.
Let's wrap up with this vital takeaway from our source material on financial resilience. Quote, true financial control isn't about avoiding mistakes, it's about building the systems to course correct them before they become fatal. You now have the blueprint, you know the traps, and you've got the exact steps to fix them. So I want to leave you with one final urgent question. When will you actually sit down, audit your books, and apply these specific fixes to your business? Because honestly, the health of your business depends entirely on your answer. Thanks for hanging out with me on this explainer, and go take control of your numbers.